Folks, the long-awaited preliminary economic assessment for Snowline Gold's Valley project has finally been delivered to the market. And at a high level, boy did they deliver. We're talking a near tier 1 operation here, depending on how far out you want to look in terms of the life of mine. And with the announcement of another discovery in the area, that tier 1 status just might be cemented depending on how Snowline ultimately decides to package this baby up. And of course, the multi-billion-dollar net present value attached to this PEA has investors already speculating about potential buyouts. Folks, let's dive in. Don't miss the Rules Symposium for Natural Resource Investing happening July 7th in Boca Raton. If you can't make it in person, that's not a problem. You can get your ticket to watch live online or on demand. We'll be there with the deep dive, so if you make it out to Boca, come say hi at our booth. If you want to sign up, click on the link in the description to get your pass. All right, let's start from the top. Snowline has delivered a preliminary economic assessment on their Valley deposit, which is part of the larger Rogue project in Canada's Yukon. The PEA represents the first economic assessment conducted anywhere on the property, and it comes after just 4 years of exploration, which in that time the company has moved from literal soil sampling to now a PEA, which is a fairly advanced timeline relative to some explorers out there. Maybe not everyone is a lifestyle company after all. Well, it's easy to get excited over the big numbers reported in the study, which we'll get into in a second. We'll tamper expectations a little bit here in terms of future development timelines. And that isn't even necessarily related to Snowline. But the appetite for mining in the Yukon is a bit subdued post-Victoria Gold and their tailings collapse. So don't be shocked if regulators drag their feet a bit here in terms of pushing forward with permitting when the time comes. With that being said, let's get into the details here. Okay, so the proposed mine here being put forward by Snowline is huge. The conventional open pit mining and milling operation is expected to have a nameplate processing capacity of 25,000 tons per day, or about 9 million tons per annum. Over the 20-year mine life, the operation is expected to average 341,000 ounces of gold production annually. However, much of that is front-weighted, with the first full 5 years of the operation expected to average 544,000 ounces of gold a year. That front weighing, while convenient from a payback period standpoint, is actually a result of how the gold is distributed within the Valley deposit. Average head grades during the first 5 years are expected to average 2 grams per ton, while average grades over the entire life of mine are lower at 1.3 grams per ton. The estimates are based on a mineral resource estimate released by Snowline back in May, which outlined that Valley contains 7.9 million ounces of gold at an average of 1.2 grams per ton within the measured and indicated category. That resource impressively follows just 53,000 meters of drilling. Snowline, to their credit, however, was quite conservative in the overall report, with the PEA being based on a subset of that resource estimate, while also using a higher cutoff grade of 0.4 grams per ton versus the MRE, which was conducted at a 0.3 grams per ton cutoff. This higher cutoff was used as a result of the PEA pit design and processing estimates utilizing a gold price of $19.50 per ounce, whereas the MRE used a gold price of $23.50 per ounce. For those new to the space, a cutoff grade is determined based on the economic viability of extracting mineralization. Therefore, with a higher price of gold, you can use a lower cutoff grade and vice versa. Getting back to the proposed mine, the selected pit shell contains an estimated 171 million tons of mill feed at 1.3 grams per ton and 186 million tons of waste, resulting in a low strip ratio of 1.09 to 1. As we said, higher grade ore will be prioritized in the initial years as a result of how the gold is distributed in the ground, which conveniently supports strong early cash flow. In terms of processing, a standard flow sheet consisting of grinding, gravity separation, and carbon in leach followed by cyanide detox will be used to ultimately produce gold doré bars. No heap leaching will be used in the project, which goes back to our comment on Victoria Gold, while recoveries are estimated at 92.2%. But one of the problems here is the infrastructure required, which of course leads to higher capex. Year-round access is needed for Valley, which means that a road needs to be constructed, a 130-kilometer long road to be exact, which includes the need for a bridge over the Pelly River. On top of that, that 130-kilometer road will link to the government-maintained North Canole Road, which also needs upgrades. Outside of the roadway, plans exist for a 1,400-meter-long airfield for crew rotation and select supply delivery, alongside support facilities for fuel storage and runway maintenance. A short-term 750-man camp will also be required for the construction phase, while a more permanent 250-person camp will be needed once operational. On top of this, required infrastructure includes the standard admin offices, warehouses, maintenance shops, medical and environmental services, and an incinerator, alongside the obvious process plant, fuel and power infrastructure, water and tailings storage facilities, and waste storage facilities. Power on site is to be generated via on-site diesel generators, with a planned install capacity of 60 megawatts. All this infrastructure, of course, doesn't come cheap. Total initial capital required for Valley is estimated at a whopping $1.7 billion, which includes $246 million in contingencies. The largest expense items here are surface infrastructure at $612 million, the processing plant at $480 million, and water management at $221 million. On top of that, the mine itself is expected to cost $217 million to establish, while the tailings facility adds the final $155 million to the mix. That estimate includes $84 million before contingencies and upgrades to the government-maintained North Canole Road, as well as the bridge over the Pelly River. Construction overall is expected to take 3.5 years for the operation, including those road upgrades. Sustaining capital over the life of mine, meanwhile, is pegged at $1.4 billion, while reclamation and closure costs are estimated at $261 million, including a post-closure allowance of $89 million. As for operational costs, they are estimated to be so low that, quite frankly, it's a bit hard to believe if we're being honest. Operating costs are expected to average $37.09 per ton processed, while cash costs over the life of mine are estimated at $690 an ounce. For those first 5 years of full production, cash costs are estimated at just $460 an ounce. All-in sustaining costs, meanwhile, are pegged at $844 over the life of mine, and just $569 an ounce over those first 5 years, which quite frankly is tough to believe considering the remoteness of the project. That figure would place them in the lowest cost quartile globally. And those first 5 years, if we're not mistaken, would see Valley as the lowest cost production mine globally. Even Artemis's Blackwater, found over 1,000 kilometers to the south in BC, is expected to have an AISC in the range of $670 to $770 post achieving commercial production. Anyways, all this leads to an after-tax net present value of 3.4 billion Canadian dollars, alongside an IRR of 25% and a payback period of 2.7 years, at $2,150 gold using a 5% discount rate. If you bump that gold price to $3,150, which is still a bit below today's pricing, the NPV rises to $6.8 billion, while the IRR moves to 37%. And the payback period then just drops to 2.1 years. As you can probably guess, investors were elated with the results. To say they were excited, at least verbally, might be an understatement. But not everyone was buying into the numbers. Some, such as Fool's Gold, simply think the AISC figures are unrealistic, while others, such as Oliver Grob, highlight the fact that a PEA is often overly optimistic on a few fronts, and there might be an issue or two that need to be resolved to get this to a mine. Others are questioning why the majors aren't tripping over themselves to buy up Snowline, while some are simply speculating on who it will be to pull the trigger. Those with some experience in the space, however, are operating under the belief that in this gold environment there's no rush to buy, and instead they want to see Snowline spend the money to advance Valley more on their own dime first. And then there's those who think that the numbers can get even better with some optimization, or through the introduction of leach pads a few years down the road once the dust settles on the Victoria Gold debacle. And it seems all are hopeful for the production profile increasing. And that latter point, which comes from CEO Scott Birdall, who spoke on a related conference call after the release of the PEA, is especially noteworthy, following the announcement in early July that a new reduced intrusion-related gold system target was found near Valley. Referred to as Celestic, the system was found just 27 kilometers from Valley and 5 kilometers from the existing trails on the Cynthia property. The discovery consists of quartz-sheeted veins hosted within a 4.5 by 3 kilometer granodiortic intrusive. Samples returned assays of 11.7 grams per ton gold from vein material, with a continuous 4-meter-long chip assayed at 1.09 grams per ton gold. All right, so let's wrap it up. The numbers reported here in this PEA, quite simply, are outstanding. That much is undeniable. While some aspects might be tough to believe as being real, aka that ASIC figure, at the end of the day, preliminary economic assessments are just that. Preliminary. It's a baseline to ensure that what an explorer is doing is on the right track before they sink even more money into a project. And even if that figure nearly doubles, it will still be a rather low-cost operation. And given the scale here, the entire asset will undoubtedly be bought out by a major at some point. The only question here is when. As it stands, Snowline is projecting Valley will be construction ready by 2030, which leaves plenty of time for further development before discussions begin on buyouts. All right, everybody, thanks for watching. Next week, we're going to be at Rick Rule bringing you guys the heat. So if you get a chance, check out all the interviews we're going to be doing. I think we're doing over 20 interviews next week. So after I finish filming this, I'm off to sunny Florida, where I'm going to even get more of a tan than I already have. And I hope you guys will check out some of that content, because we've got some really great interviews coming up. Also, if there's stories you want us to know, you know what? We are the hardest working guys in the business. I swear, I know everybody says that, but we will cover stories while we're in Florida, even if we got to record the content on site at the Boca Raton. All right, everybody, thanks for watching. If you enjoyed this video, do me a favor, smash that like button, subscribe, and ring that notification bell. All right, everybody, thanks for watching.